Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about what's going on in share markets, not only in Australia but around the world. Before I get into that topic, I would just like to take a minute to thank everyone that listens to this podcast each week. As you can imagine, a lot of effort goes towards producing it. It's my own content. Unlike other podcasts, I don't have, purposely so, don't have guests to sort of share the heavy lifting, I guess. And I appreciate it. And it is becoming more and more popular, which I'm very proud of. And it's certainly thanks to you, the loyal listener. So thank you for that. And of course, if you want to leave a rating or start following the podcast, that obviously helps the ranking and more people will learn about it. So I appreciate it. Okay, so let's get into the share market then, which I wanted to talk about this week. And essentially, the calendar year-to-date return in both the share market and bond market have produced some of the worst returns on record. In fact, looking back over nearly 100 years, there's only been a couple of times over that period of time where the bond market and the share market have produced such horrible negative returns. So it happened in 1931 and 1969. And then obviously this year, 2022. So it really is a very unique market. And it's all bad news. In fact, I appeared as a guest on the Australian newspaper's Money Cafe podcast last week. And the editor that I work with there, James Kirby, asked me, are there any asset classes that have actually produced a positive return? And my answer was no. Commodity prices have come off. Gold prices have come off, bond prices have fallen substantially, share markets have fallen substantially, infrastructure's fallen, property's fallen, residential Australian property has fallen, although I should note that if you look at median house prices, they're about the same value that they were 12 months ago, but certainly this calendar year they've fallen sharply. And perhaps the best performing asset class would be cash. Put your cash in the bank and you earn very little return, probably more return today given that rates have risen substantially, but certainly not shooting the lights out return-wise. But cash has probably been the best asset class in terms of performance this calendar year. So really horrible year, but very unique year. And so what I wanted to do today is just talk about some of the risks or issues that the market is contemplating at the moment that's producing these really poor results. And then once I've done that, I'm going to finish off by giving you some good news and talking about which geographical segments, which share markets exhibit the best opportunities for future returns. Okay, so we probably won't see a sustainable share market recovery until equity markets can ascertain what the terminal cash rate will be. Now, the terminal cash rate is really the peak cash rate. So how high do interest rates need to go in order to get inflation under control? And if it turns out that cash rate is lower than what the market has priced in, then the market recovery could be quite strong. If it ends up to be the same or even higher, the market can still recover because uncertainty is still priced into the market, but at least then they can get their head around what that might be. In Australia, the market has priced in a terminal cash rate of 4%. We're at 2.6 at the moment in terms of RBA cash rate. So it looks like that the market has certainly overcooked interest rates here in Australia. And once we learn what the terminal cash rate will be here in Australia, it's quite possible the Australian market will recover, although there's a whole bunch of other things that could impact the market during that time. And in the US, they're toying with a terminal cash rate or Fed's funds rate of between 4.5% and 5%. They're currently at early 3%, so they've potentially got some way to go. The actual amount, I'm going to say the actual amount of the cash rate, so what that terminal cash rate ends up being, is less important than really the certainty about what that terminal cash rate is. So the uncertainty around it, will it be much higher, will it be much lower, that's what creates the volatility. And then until we can get a head around that, we really don't know, or we can't expect a sustained recovery in share markets. Conceivably, we might have to wait until the end of this calendar year, start of next year, for the market or for the terminal cash rate to become more ascertainable. So I suspect we'll probably continue with the volatility for at least the rest of this calendar year. The other thing that the markets are contemplating is recessions, and if so, is it a deep recession, is it a shallow recession, is it a technical recession? How bad will it look? And that is linked to the terminal cash rate, of course. If the terminal cash rate is going to be higher for longer, then that's going to cause some economic pain. However, if the central banks can pivot and hold rates at a certain level and wait for the data to come through about whether they're going to be effective, and manage it perfectly, that they tighten the economy and slow down growth only enough just to curtail inflation, but not too much to cause a recession, then we'll be okay. Of course, central banks have risen rates almost faster than any other time in history, without the data to ascertain whether they're effective and how effective their tightening might be. So therefore, there is a downside risk that central banks will tighten too much, and it'll be too late by the time the data comes through about the impact of these rate hikes. It might be too late. They might have already tightened too much by that stage. So I see that the rhetoric really with central banks is changing. The RBA increased only by 0.25% last month, and they might do another 0.25% in November. And even the Federal Reserve in the US is suggesting that they might start slowing the pace of interest rate increases. So that's a good sign that they're going to wait for more data to demonstrate that that interest rates are working. We saw labour market figures in Australia released last week, and growth in the labour market was a lot slower than what the consensus was going to be. And SEEK released their job ads figures also towards the end of last week, and they're coming off as well. So it looks like that there's some very early signs that these interest rate increases are working in Australia at least, and that's kind of good news in terms of interest rates, that we might be getting closer to that terminal cash rate than further away. Of course, the big news and the big uncertainty and the big geopolitical risk is, will there be a nuclear war in Europe as a result of Russia's invasion of Ukraine? And of course, I'm not a geopolitical expert by any stretch of the imagination, but any sort of uncertainty worries markets. So what will the impact be of a nuclear war, or even a World War III? I'd imagine it would cause a lot of volatility. And it's really hard to predict what impact it might have on share markets, other than looking back almost 100 years ago to see what impact other world wars have had. But every time is different, and certainly if we're talking about nuclear war, it's pretty worrying. So, but there's nothing we can do as investors. We can't overreact to these potential risks. And as long-term investors, we know that if we've been investing for 100 years, over that time, returns have been pretty good and pretty predictable, I would say. So let's talk about the good news. And the good news is that when markets face uncertainty, they tend to price in maybe not absolute worst case scenario, but tends to be quite worst case scenario. So they tend to price in all the risk. And I would argue that a lot of these risks that I've just spoken about have been, if not fully, mostly priced into current share prices. So the share market has come off 25%, the US share market, since January. And that's mostly driven by a reweighting of valuation multiples rather than earnings. In fact, we're in the middle of third quarter earnings announcements at the moment, and really they haven't been that bad, not nearly as bad as what the market might have expected. So At a sort of macro level, underlying corporate earnings remain quite robust. I mean, they're still down a little bit, and interest rates will have an impact, of course, but they're still pretty robust. It's really a reweighting of valuation multiples, which is really factoring the risk into the market. And I'm talking about fundamentally sound companies here. Of course, there's a whole lot of zombie companies. Zombie companies are the ones that really don't have the cash flow to fund borrowings. I'm not talking about them, of course. They've fallen a lot in value, those type of companies, and they really probably don't have the fundamentals to ever recover. Okay, let's talk about the geographical markets then that exhibit the best opportunities for future returns. And I've utilised some data that's produced by a research house called Research Affiliates in the US, and they use a variety of tools and approaches and methodologies to really predict the probability of future returns in different markets. And a lot of these tools and methodologies are generally accepted, have been peer reviewed and so forth, and they tend to have a high correlation rate. So they're not a perfect predictor, but they've got a very high correlation rate, 70-80%. So it's a good indicator of perhaps where should we not be placing massive bets because you never know when the returns transpire, but where can we tilt our investments towards to expose our portfolio to potentially higher returns over the next 10 years. And these predictions really are longer dated returns, so average returns over the next 10 years. And the best sub-asset class is emerging markets. As you can imagine, emerging markets have been really smashed over the last year and a half. A lot going on with China, of course, and trade tensions, and bringing manufacturing onshore in the US and so forth. But a lot of the investment theses or thematics that made emerging markets investable 12, 18 months ago still present today. They still have weight today in terms of benefiting from their massive scale. 1.4 billion people in China, another 1.4 billion people in India. They can produce a lot of economic growth coming out of those countries over the next period of time. Plus also, if our starting point is very low valuation multiples, which it is at the moment, emerging market valuation multiples are incredibly low, then future returns are likely to be high. And the modelling from Research Affiliates suggests that the 10-year return has a 70% probability of being between 9.5% and 15.7%. Now, you've got to be careful with emerging markets. You wouldn't put huge amounts of money into them because they can be more volatile. But really, that's the best sort of sub-asset class that exhibits the best returns. Australia is next. The Australian market, 8.4 to 13%, 70% probability of between being in that range over a 10-year period of time. So they're compounding returns. Europe, 7.2 to 11.8%. Then the UK, 5.3 to 9.5%. The US is next, 4.1 to 8.9. Japan is close to the bottom at 3.7 to 9%. And just international markets, just the MSCI index is 3.3 to 7%. So it sort of shows that if you're going to be very indexed and just go the developed market index, that's not actually necessarily going to expose you to the sectors that are likely to generate better returns. Noting that the US, being the biggest developed economy in the world, is likely to underperform expectations over the next 10 years. And that's really just because of its sort of starting point, and it's got some of those zombie company exposures in there as well. So by now, as a loyal listener, you'll know that I use an evidence-based approach towards investing, which often means a low-cost rules-based approach to investing in share markets, so indexing. It's important to point out that different indexing strategies will perform differently in different markets, depending on the different opportunities those markets present. So, for example, the data from Research Affiliates suggests that Value is likely to outperform growth over the next 10 years by circa 2.5%. So using a indexing methodology that tilts towards value will likely then also produce that outperformance, but also, and I think quite importantly so, reduce the overall portfolio's risk. So really, in summary, the market is terrible and there really is no good news in terms of year-to-date returns. And really every asset class has really had a pretty poor year. It's quite possible that if you invest in the market today, you may not actually be better off in 12 months from now. However, if you take a longer-term approach and use evidence-based methodologies that are low cost, it's very likely that in 5 to 10 years, you'll look back at 2022 and think, gee, it really offered some great investment opportunities. So at the moment, it's really difficult to see anything other than risk. But really, in reality, if we look at these longer-term trends, there really are great investment opportunities at the moment, although you have to leave room for the possibility it's not absolutely possible to buy at the bottom. So if you start investing, it's possible that you'll rack up some losses before they turn around. But in the long run, 5 to 10 years, if you do it correctly, a good chance of you generating some really healthy returns. Okay, so that's it for this week. I hope that gives you a bit of insight to what's going on in the share markets. Until next week, bye for now.